UTI Focused Equity Fund endeavors to build a concentrated portfolio of up to 30 select high-conviction ideas. Our edge in picking such high-conviction ideas is underpinned by our well-laid-out investment process and an experienced team tracking a large set of companies. The fund aims to have an optimal level of portfolio diversification by investing across sectors and market capitalization. It is uniquely positioned with a distinct portfolio relative to broader market indices with the potential for alpha creation. The fund's emphasis is to cut through the clutter by separating the wheat from the chaff.
There's a vast universe of stocks out there. Spotting the right wealth creators out of a plethora of options is not easy. With today's access to knowledge and information, one may think it is easy to build a concentrated portfolio of our own. But then again, a few bad apples can spoil the barrel. Inclusion of a few wrong stocks may spoil the performance of your overall portfolio. For instance, the return divergence of top and bottom performers of the NBFC sector is 4x to 42x, while the same in the manufacturing industry is 8x to 175x over the last 10 years period. Therefore, focused stock picking is the key to wealth creation.
This is where you need the help of a team of experts who can make the right stock picking much easier with their experience, robust research framework, and access to data and resources. UTI Mutual Fund's research framework equips our fund managers and investment team to pick the right apples and exclude weaker names based on certain parameters. Our internal evaluation rating system evaluates companies across several parameters and drives the exclusion filters as well as the selection process. We believe that our stock selection itself is the most efficient risk mitigation strategy.
The fund intends to build a concentrated portfolio of high conviction stocks. The fund has a unique three-pillar investment strategy, wherein we would build the core portfolio with stocks having the potential of long-term sustainable growth. We would also invest in transformational opportunities, where we would pick businesses where strategy is being realigned to make the outcomes more sustainable, and pick cyclical opportunities where valuations are attractive and benefit from mean reversion. As an exclusion filter, we attempt to weed out stocks with corporate governance and minority shareholder issues, high-levered businesses with sustainability challenges, poor operating cash flow generation, and ROCs lower than cost of capital through the cycle. The fund's portfolio approach through its bottom-up stock picking strategy is to strike a balance between risk and reward.
If we go back in time and analyze how companies in the Nifty 500 have delivered returns over the decade, we realize that there is a vast divergence in return outcomes of these companies. When we break down what we see is that 15% of the companies have exited the benchmark due to a variety of reasons. Delisting, liquidation, shutdown, mergers are some of those reasons. 20% of the companies have generated negative returns over this period. About 25% of the companies just managed to deliver positive returns, but below the benchmark return of 12.81% for the Nifty 500 TRI index. During the same period, the remaining 40% of the companies managed to deliver a relatively better return outcome than the benchmark index. Our endeavor is to pick companies with the better return outcomes and exploit the return divergence through stock picking. This is combined with the larger position sizes that can help create potential for higher alpha. To summarize, the fund strategy is to create a balanced portfolio by picking a core of sustainable businesses to which we add transformation and cyclical opportunities. The exclusion filters aid in avoiding weaker names, and the concentration-driven position sizing accentuates the portfolio outcome.
Our bias is towards quality companies determined by high ROCs and consistency in OCFs. The fund's flexibility to invest across market cap and sectors helps us to stay focused with concentrated yet diversified portfolio. Let us look at a couple of our investment ideas that fit into our investment framework. Small housing finance companies with an average ticket size of $500,000 to $1.5 million are well placed to capture secular growth in the affordable housing segment in India. This company's asset quality has remained stable despite the high growth in AUM for the last 5 years. We believe that this is a potential sustainable player in the space. Another idea is of a leading auto component player, which is a proxy to play the imminent upcycle in the two-wheeler segment and has consistently outperformed the underlying industry. Its consistent high ROC reflects its focus on lean operations and strict capital allocation. We would focus on similar growth-focused ideas which fit into a theme of concentrated portfolio after passing through our investment framework.
Investors who have a long-term goal of wealth creation and are willing to take on a potentially higher risk of a concentrated portfolio can consider investing in this fund. This portfolio has the potential to earn relatively better returns than the broader market, led by high conviction and concentrated approach, backed by the research expertise and risk assessment framework. If you want the power of focus, then consider investing in UTI Focused Equity Fund.
UTI Focused Equity Fund, an open-ended equity scheme investing in maximum 30 stocks across market caps. NFO opens on August 4th, 2021. NFO closes on August 18th, 2021. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.